Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. If you Google the word recession, you'll notice a pretty clear trend. Search spikes tend to peak during actual recessions. Today, Google searches for recession are at all-time highs for the sort of pre-recession period, if you will. But our next guest notes that this doesn't necessarily signal an impending downturn. In fact, the data tells her that the market might have hidden opportunities for growth, and the current market drop that we've seen in the last couple of days and is correcting now might not be as bad as investors think. Joining me now to discuss which market indicators are shaping her analysis this week is Fidelity Director of Quantitative Market Strategy, Denise Chisholm. Hi, Denise, welcome.
Well, great to be back.
Great to have you here. We're going to talk about tariffs in a sec, but I just want to get to this little Google search, really? Like, seriously, are you measuring Google searches? You seem like you measure much more interesting things to me.
Yes, you can. I mean, you can measure, I measure a lot of things, but I mean, Google is a great way to measure what's in sort of the common consciousness. And as stock market investors, you know, once something seeps into the common consciousness, usually it's priced into the stock market. And I think that that's what this data proves. And anybody who wants to see the data and the trends that I'm going to talk about, just go to my LinkedIn. You can see the charts of the week. I mean, it's really intriguing in the sense that once you see recessions trends trending in the top 5%, we have the data back to 2004, what you see is a fairly linear relationship. The more recession is trending, the higher stocks are likely to be over the course of the next year. So the more fear that is pervasive or persistent in the data, the more likely stocks have already priced it in and are likely to rally. Now, the glaring inconsistency this time, because we are seeing what I like, a lot of anomalous signals, right? We saw a spike in implied correlations. That's pretty mathy, which is very much the equivalent of Google Trends. We saw a top 5% rotation into defense, those consumer staples, healthcare, utility sectors. We've seen a lot of extreme movements, and from bullish bearish sentiment to something we've seen only in the Gulf War. A lot of these extreme sentiments, but the market's not really down a lot. I mean, we've seen a correction, certainly 10%, but even when you look at over the last 6 months, it's really flat-ish. And so you say, okay, is this the problem? Do we have to true up to a recessionary-like correction to match up with that recessionary-like sentiment? And historically, even in that 10 to 20% of that top quartile of these anomalous signals, what you find is usually the less the stock market has gone down, the more likely the stock market is to be higher, almost as if the stock market is predicting itself. And so the internals of the market, all of the data that I see, again, we can talk about the headlines, but the data that I see do show that if you're willing to extend your time horizon 6 to 12 months in the future, I'm not talking about a bottom today, yesterday, even in a month, I do see opportunities in the equity market.
That's fascinating. And you've often coached all of us to look a little further out. But here we are actually in, I mean, we don't know if it's the bottom, but we certainly know that there are some things that have been announced that have been expected. There's been this uncertainty because there's been no announcements. Boy, yesterday was a wallop because we got 25% tariffs on cars that are not made in the United States, and Canada will feel that significantly. So it felt like an announcement to get rid of some of the uncertainty. And we actually see U.S. markets turning up.
Yeah, it's odd that way, isn't it? I mean, in some ways, the more visible the deadline or the headline is, the more likely the stock market is to discount it. And that's, you know, what we caution investors in terms of potentially selling on bad news, because we know really by looking at history that markets bottom on bad news. So if you use bad news to get out, it's very tough to create a signal to get back in. And that's why I think it's important to focus on the data. Now, to the extent that the data it's quote different this time, we can assess and evaluate those differences. And as much as it's different, I do think that the historical framework is we need to add up the impacts of the tariffs and assess whether or not it is a significant shock to the US consumer. You can do that by looking through history and saying, what have recessionary shocks been in terms of a percentage of income? And you'll notice that they, you know, range between 1.25% or 1.5% to 2.5% when you look back to the 1970s. So it's important to understand that most of the shocks come from either interest rates historically or more likely oil prices. And they tend to be direct hits to the US consumer. Tariffs are not a direct hit to the US consumer. There is this substitution effect, right? I mean, as much as people talk about it as an inflationary impulse, history shows that really you're more likely to see disinflation or even deflation in Smoot-Hawley than you are likely to see a spike in inflation. And that's mostly because tariffs act like a tax. And it doesn't end up all on the US consumer, because the US consumer is sort of can substitute away some of the impact, right? So that's true of avocados, right? You can buy less avocados or stop buying avocados. Obviously, that's less true in terms of steel or aluminum or potentially cars. But what you do see is it doesn't all end up on the US consumer. So those close to the administration are talking about potentially $300 billion all in tariffs. If half of that ends up on the US consumer, that's about a 40 basis point headwind to consumption. We've seen 40 basis point headwinds before to consumption, most likely in oil prices, and that's usually not enough to be a tipping point for consumption, for earnings growth, or for US GDP. So using that framework, again, with history as a guide, what we've seen and what we are likely to see might not be enough to tip us into recession. Always remember that recessions are very, very rare historically and not easy to get into. So I do think that that provides a framework. It would have to be much higher to be that tipping.
And the reason that it becomes sort of disinflationary is that it's tied, I guess, to the substitution. You're not going to buy whatever it is that's tariffed. You might substitute with something else, but overall you have less to spend, and therefore prices are going to shoot down a bit.
That's exactly right. I mean, in some ways, it's that inflation is always and everywhere a monetary phenomenon. If the price of washing machines goes up by 25% and you have to buy a washing machine, well, then you have less money to spend on other goods. And they lose the pricing power because people have less to spend. So that's why, look, we don't have a lot of historical instances of tariffs. There's about 5, historically speaking, and they're certainly not of this magnitude with the exception of Smoot-Hawley. But when you look at all of them, all of those 5 instances, the overall CPI, which is not to say whatever was tariffs, but the overall CPI decelerated 12 months out in every single instance. So I do think that that's this historical red flag of saying, look, I know that people are worried about a spike in inflation, and you may get it over a month or two, but it is likely to be what Chair Powell said, perhaps more transitory this time, to bring back the T word, this time, and have a bigger impact on growth and have a less impact on inflation.
So interesting. I mean, some of the readings, tell us about some of the readings that you're looking at, because some of them are swinging all over the place. And I think you have said even as much as, even more so perhaps than we saw in COVID, in terms of the uncertainty that you're trying to get out of these readings.
Yes, the uncertainty levels, I mean, again, if you think of uncertainty being going from bullish sentiment to bearish sentiment, you can measure that with the AAII, or American Association of Individual Investors. We shifted the fastest since the Gulf War. So, and now we are at bearish levels, really not seen really only seen in prior recessions. Again, those readings, now that we are there, do suggest that if you're willing to look out 6 to 12 months, it's kind of too late to be bearish, statistically speaking, meaning that the lower you are, the less bulls there are, the more likely the market is to go up. Again, that doesn't mean that I think today or tomorrow is the bottom. But again, that glaring inconsistency back to these sort of unique signals is that the market, it's been quick, but the market's really not down a lot, certainly not relative to what we saw in 2022, even, which also wasn't a recession. But when you look at that historically, that factor is more protective. It's almost like the stock market intuitively understands that mid-cycle earnings might be less of an impact. So in some ways, a lot of the all of the extreme anomalous signals of bullish to bearish sentiment, how uncertain people are, economic policy uncertainty, which is now at COVID levels. These are all signals that are contrarian signals of opportunity.
Wow. Okay. Tell us a little bit about how we would measure, I think you've looked at various frameworks, and tell us what some of the offsets are. Okay, we're going to talk about autos. You don't need to tell us everything about the auto industry if you don't know it, but what are some of the examples of offsets that we might see, in any economy when it's taking a bit of a swipe in one area?
Yeah, well, the odd one that we're seeing, or we saw, I don't know exactly what the price is today, is oil prices coming down. I mean,
Right.
this is the interesting part when you look at the market reaction to tariffs. What have we seen? We've seen oil prices fall and interest rates fall, right? I mean, bonds are actually protective
Yeah,
in this
interesting.
situation, which is maybe not what investors expected going in. So back to those billions of dollars we're adding up in terms of the tariffs and what ends up on the US consumer, what we've seen in some ways is a direct hit or tailwind to the US consumer of the fall in oil prices to the tune of about $80 billion. Right, so we'll see if that stays, but right now that's actually been a significant offset that you can measure historically speaking. I think a bigger one that is more definitional of this cycle is the credit impulse that we've seen. Remember, I think going into this year, we talked a lot about how this cycle has been very off cycle, and small businesses' access to credit has been impaired in a recessionary fashion since 2022. And despite the fact that there was sort of a back and forth in a lot of survey indicators in terms of once the administration took power and then a sort of resurgence of what do the tariffs mean, this has been a one-way trade in terms of small businesses saying, we have more access to credit. And you are seeing that confirmed in an inflection in loan growth. And that's very unique, right? And you usually don't see that going into a recession, and it's usually a tailwind for future earnings growth, for future even multiple expansion, for economic growth, and for the US consumer. So I do think that those two tailwinds, we should always remember when we're adding up the headwinds in terms of tariffs, the tailwinds of lower oil prices, lower rates, and better access to capital in terms of what has been in a prior recession.
From the Fed's perspective, we also saw them QT wrap that up for now too. So that also goes in as, I mean, offset. You can call them cushions, I guess, whatever you want to call them, but they're protective.
Right. It definitely is protected. I mean, there was certainly a fair amount of investors that I always talk to worried about that QT overhang in terms of less liquidity at banks, even though we're, sort of above average reserved in our banking system. But in terms of that being a potential another headwind, and that headwind looks also off the table. And we'll see in terms of what Fed rate cuts might bring. I think that, again, there was a lot of investor concern of tariffs creating price impacts that keep the Federal Reserve on hold. But even with the changes in the dot plot, a small shift up in inflation, a small shift down about growth, we're still seeing the Feds expecting to cut twice more in 2025, which is, again, a different situation of the last time we were looking at tariffs in 2018.
Is your fear gauge, I don't know if that's what you call it, but it's, it's certainly is used, applicable in the case of a tariff war scenario, which could be damaging to economies? Yeah, to various other economies as well.
Yeah, back to it's different this time,
Yeah.
right, Denise? I know that you're saying, like, yes, everybody's fearful, but it's so different. The interesting part about this fear gauge worked in things even like COVID, right? Which obviously there was no precedent for all of the major economies shutting down at once. So that's the interesting part, I think, from a behavioral perspective. It's not that it's not different this time. It's absolutely different this time. It's always different. The question I think you have to ask yourself as an investor is it different enough to change the patterns that have persisted despite the differences? And I think that that's the important math. And in some ways, that's why I'm a quant, because I like all the signals associated with these issues that have that pattern regardless of the differences in history. So that's why I'm trying to read the data as opposed to trying to read the headlines.
When you see things like initial jobless claims come in today, still not really showing anything from Doge cuts, for instance, hard to know when that will or won't show up again, but just give us sort of the labor side of things, which obviously would affect the Fed as well.
Yeah, the labor side of things is interesting. And I'll tell you what portfolio managers asked me. I just had two conversations, one with Tom Allen, one with Bill Bauer, different, US mid-cap and then international fund managers said, hey, Denise, I'm talking to corporate America and they're worrying me in the sense that they're saying, look, we don't have certainty. We're kind of sitting on our hands. And I said to them both, the problem that I have with using that argument as the potential bear case is when I look at the data, they're already sitting on their hands, and you can measure it. So there's no firing in overall America as opposed to Doge, right, which is, again, a small portion of the workforce, but there's also no hiring. There has been no hiring and no churn in the labor market, albeit a good labor market in the sense that we're near full employment. There has been no firing, but there has been no hiring. There has also been very little capital spending. You can measure it in core capital goods, right? So we're not seeing any movement, right? Maybe corporate America is telling you, hey, we're not going to do anything yet until we get clarity. But really, what they're telling you, I think, in the data is that we're just doing more of what we've been doing, which is not a lot. So I think that the job market, when I look at it, is fine in the sense that there's this steady state. And I don't think that the Doge cuts, when you sort of do the math behind them, and even we saw in 2013 sequestration, which was actually bigger, is enough to move the needle in the overall private sector. So when you sort of put these two things together, what you're left with is, well, let's look at the leading indicators that matter. And the leading indicators that have mattered is that inflection in credit. So to the extent that we are finally seeing small businesses gain access to credit and lending growth improve, then job market is likely to follow. Back to the, is it different this time? Going through the math of tariffs, it might not be big enough to be different this time. And going through the math of Doge, it might not be big enough to be different this time. So you're left with, as an investor, to say, do I want to bet on it being different this time and being big enough or getting bigger? Or would I like to bet on the data and the trends that I'm seeing? And I'm always left with, I'd rather bet on the data and the trends that I think are predictive.
So the credit impulse and smaller companies having access to credit and therefore potentially hiring more people could soak up any issues in the labor market in terms of job losses.
Correct. The private sector, I mean, when you look at the math behind sort of Doge, it's interesting. So if you said, like, does government spending actually correlate to future GDP growth? What you'll find is the opposite of the relationship that you thought, meaning that there's not a lot of fiscal stimulus that filters through to the US economy. What you do find is that the lower government spending is, the more likely private markets are to grow, GDP is to grow, and earnings growth is to grow. And that is true outside recessions as well. So obviously the data shows that inside recessions. But I think that that's unique in terms of the economic theory it supports, is that more often than not, and again, there's never any guarantees in the data, but more often than not, government spending actually crowds out the private sector. So to the extent that there is less government spending or even less government hiring, that usually means that you're seeing the private sector actually grow and employ more people. And to the extent that you're looking at the ultimate lead indicator in terms of corporate America's hiring, it's less about certainty, because I don't see that as predictive historically, again, usually because you've already not hired. The biggest leading indicator is corporate profits. And what we just saw come in for Q4 in the GDP accounts was record high corporate profits. So to the extent that corporate America is profitable, they tend to hire, despite the fact that they might tell you that they're doing nothing. They do something when they need to sort of, meet their economic plan for the year.
There seems to be a risk of additional tariffs. Do you have any thoughts regarding the extent of tariffs that need to be applied before the American economy might be pushed into recession? And you did comment on that. Just take us back there.
Yeah, so I'll give you my framework. So two things, one on the date and on more coming. Again, remember just about dates, the more visible dates are, the more likely the market is to bottom at or around them. And I say that's not because it might be different this time, but I do say that just as an investor of learning from history. So back to the framework, what would get you to 1.5% to 2.5% shock? I think it has to be something like 30 to 35% across the board on the $3.2 trillion of imports.
So not just auto sector, like across the board.
Not just autos, not just, right, 30 to 35% across the board on the $3.2 trillion of US imports. That would be a shock enough to be even more than what we saw in 2022, likely, and something more like what we saw in the 70s. Anything is certainly possible, but that's the framework that I'm using to have that be enough of a shock to the US consumer to tip it into recession.
Is this the perfect time to buy, or should we wait some more?
Oh, so you're asking the wrong person. I see opportunity, but look, you have to remember what is Denise's job? My job is to be a research analyst for our diversified portfolio managers. When I started my career 25 years ago, somebody told me that if you swing around too much or try and pick bottoms, we run trillions of dollars here, Denise. We can't chase little basis points. I need you to sort of be long-term oriented and not be timing oriented. And that's much more important to our diversified portfolio managers. So with that, I have instilled a process that does really look 6 to 12 months and doesn't look for individual bottoms or say, should we bought last week? Should we buy next week? Do I see opportunities here if you're willing to have a 12-month time horizon? I do. And it's all around those signals. I mean, even valuation spreads in the S&P 500, which are the larger cap indices, now did spike into the top quartile levels on the low of 313. It doesn't mean we won't take out that low, but I do think that it shows very clear opportunities in the equity market for those who are long-term oriented.
That's fascinating. Just more on the date, which you mentioned, the Gulf War. What was that? You said that because the date was known. Just take us back there. What was that?
Yeah, it's actually a research paper by, if anybody wants to follow Renmac Research, I know they're on Twitter. Jeff DeGraff actually wrote a good piece about how, when he first came into the business in, I think it was 1990, how there was definitely a red line in terms of when we were invading. And everybody knew the date and everybody knew the line. And when the line came and everybody was worried about the market had already bottomed. And that just goes to show that uncertainty can be priced in. And that you see again, over and over and over again. We saw it with COVID, we saw it with the Gulf War. You see it time and time again, which is why I'm very reluctant to ignore the indicators that I'm seeing that are sort of flashing opportunity, however strange it might be in the system of where you don't know what economic policy is going to be from day to day.
Okay, so let's go with the credit impulse. It strikes me that you're going down the cap spectrum ultimately if you're looking at companies that maybe just didn't have tons of collateral essentially to borrow before, and now they're in a different situation. So talk us through the sectors and maybe the cap size that you're looking at right now, the favorites.
Yes, we're saying, so what I've talked about a lot from a sector perspective is financials. And I still think that they're a very, very unique sector. And they've been fairly protective in this downturn, which I think surprised people, which a lot of people will tell you that, well, if financials are actually outperforming, that's probably lower recessionary risk. Not necessarily true, but I do think it shows you just how pervasive and persistent the valuation support is in that sector, or said differently, how much it's already priced in of a recession. That is where you see valuation spreads wide. That is where you see valuation support statistically. You've got credit, which still isn't up a lot when you look at high yield spreads. The bond market is not sending any signal like it sent in 2009, where the credit market was saying, hey, we've got a problem here. You're not really seeing that persistent and pervasive spike in credit yields, in credit spreads that we saw. So that's on the right side. And now you're seeing this credit impulse in terms of small businesses showing that loans are inflecting now. So you've got a catalyst in the financial sector. I think that this is one of the unique sectors in the market where I think that you're protected potentially to the downside if the market continues to draw down more. And you have a call option for all of this coming together with valuation expansion plus an earnings growth tailwind. So I think that the financial sector is really intriguing. As it relates to down the cap spectrum, we talked a lot about, depending on your risk tolerance, equal weighted mid cap or small cap. Small caps obviously have not been protected, but that equal weighted scenario has actually been quite protective in the drawdown. And I think the market is tipping its hand on that is where the opportunities are. So equal weighted index, again, when you look back historically speaking, you've got really strong valuation support. And I think from an equal weighted perspective, that is the earnings growth most tied to that credit impulse statistically. So the more you see small businesses gain access to credit, the more disproportionately equal weighted earnings grow relative to cap weighted earnings. You couple that with that valuation statistical tailwind. And I think you've got a really good risk reward in equal weighted stocks or an equal weighted S&P, with the financial sector being, I'd say that that's my top pick from a sector perspective for 2025.
Fantastic. If just talking about what you said earlier, that this has been a correction, it hasn't sold off that much. It's important to remember that. If we did see some version of maybe a euphoria or some people buying back in very, very quickly, what might that read to you?
Yeah, I don't know. The price action is always an interesting one. So statistically, I would say not a lot. The things that I'm looking for in terms of changing your risk reward are stuff we're not very close statistically on. So bottom decile credit spreads, which interestingly enough, the spike in credit spreads is almost like a bullish indicator for me, because we were getting to those euphoria levels without this sort of, 2 steps forward, 1.5 steps back that we've seen in the correction. Same thing is true on the OECD LEI. We were slowly marching towards that top quartile area. We're not there yet, but we were getting closer, which sort of changes your risk reward. So there are these factors of euphoria that I would measure, not in price, but in sort of credit, earnings growth, and OECD LEIs, which is more economic growth, which shifts your risk reward statistically. Usually what you see at the time is the best growth you're seeing is coupled with the highest expectations and the highest multiples. Our step back actually provides more opportunities that might be sort of the smoldering ability of this, potentially long-lived economic and earnings growth recovery to continue.
How long does the data lag from events and headlines sort of sit in prices or sit in the markets? Do you find, are we reacting and passing things through faster? This is the question.
So yes, in the sense that, and I'll be quick with my answer. Yes, in the sense that sentiment resets quicker and quicker each cycle, and has reset the quickest I've seen it measured statistically this cycle. And in some ways, I think that is a function of what we saw in COVID. I think you're always willing as an investor to sort of play out the last crisis. It was instantaneous and impactful. And I think that there's sort of a knee-jerk reaction to every crisis will be like that. And of course, usually you're pricing in the last crisis, and of course the next crisis is different. So I do think that there are some statistical measures to say that we are more fearful quicker, more and more, and pricing in those headlines quicker and quicker.
Right, there's sort of a resilience there on some level. Denise Chisholm, a delight to see you, and thank you so much for walking us through what really would signal a recession in the United States and ultimately where the opportunities lie. Great to see you.
Always great to be here.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.